Good evening, everyone. Welcome to our Association of Former Students Texas A&M Homebuyer Workshop. My name is Jason Maida. I'm with American Pacific Mortgage. It's great to be with all of you today. And I guess I shouldn't say good evening. It probably might be good afternoon, depending on where you're at in the country. So we appreciate you taking time out of your busy schedules to get a chance to get connected with us for Tuesday's workshop. This is a class we get a chance to teach for the association 4 times a year. So every quarter we do a workshop like this. And we're really excited because we've had a lot of success with our workshops with Texas A&M. And in fact, I'm pleased to announce we've had actually graduates from our class over the last 6 months actually buy their first homes over the last 30 days. So really cool thing. And we'll talk more about that later on in our session today. Well, again, my name is Jason Maida. I'm going to be your facilitator this evening. And we're going to kind of walk you through a very interactive workshop today. So this runtime of tonight's class will be just about an hour, but we try to weave in questions from our audience as we're going through the presentation deck. And then my colleague Ken Fleck will also be helping me answer some questions. So you can use the chat feature in Zoom or even the Q&A feature, and then we'll go ahead and answer those questions as we go through tonight's content. Well, our organization that offers this class is called American Pacific Mortgage. We're a top 10 lender in the country, and our team here specifically focuses in on educating first-time home buyers on homeownership. And so we have classes designed like this to give you all the tools and resources that you'll need to help make that big financial decision whenever that time comes. Now, this could be something you plan on making a decision in 2024. Maybe it's a goal for 2025 or beyond. We want to make sure you have all the tools and resources you have or need to make a good, sound financial decision. Well, again, this is going to be a very interactive session today. We encourage you to ask questions of us. And this is kind of what we're going to cover in today's session. So we're going to talk a little bit about the housing market, what's going on with market values across the country. We'll kind of spotlight some markets in Texas. We'll also talk a little bit about interest rates. In just a few minutes, I'm going to walk you through a rent versus buying scenario, kind of looking at a side-by-side comparison of continuing to rent versus what could it look like if I decide to purchase a home. Talk a little bit about credit and give you some ideas on how to help improve your credit or to continue to do what you're doing. We'll talk a little bit about student loans, look at various loan programs that are available to you as a first-time buyer. We'll also look at some of the documentation that you generally need to start the home buying process. And there are first-time home buyer programs that are available all across the country to help support you on this journey towards home ownership. So we'll spend some time looking at some Texas-based first-time buyer programs, as well as some more national coverage programs. And then finally, today or tonight, we're going to get a chance to look at the buying process. So after tonight's class, you may say, hey, you know what? I want to learn a little bit more about what buying could look like for me. So we're going to kind of walk you through the milestones towards home ownership. What's it going to look like to move from today's class to going in and starting the process to actually purchase my home, okay? So that's kind of what we'll cover in today's class. Again, you can ask questions using chat or Q&A, and we'll get those answered for you as we move through tonight's content. Well, let's talk a little bit about home buying. And when we think about home buying, it's probably going to be, like I said earlier, one of the biggest financial decisions you're going to make. There's a lot of great benefits that also come along with owning a home. So I can control what my monthly budget looks like. So my affordability levels is going to be dictated about what purchase price I'm at. This home that I purchase will hopefully go up in value over time. As the home value goes up, as I pay down my mortgage balance, the difference in those two numbers is home equity. Home equity creates wealth for you. In fact, in some cases, it creates generational wealth for families. So over time, this wealth continues to grow as that home goes up in value. And there still is some really great tenant tax benefits that come along with owning a home. So even though, when we look at renting, we have that rent side of things, we're not realizing true tax benefits because you can potentially deduct interest on a mortgage. So when we think about home ownership, we always like to kind of dive in and first look at a calculator. It's a rent versus buying calculator. So we can kind of side-by-side comparison, continuing to rent or making that decision to buy. And so we're going to look at a calculator. It's brought to us by Freddie Mac. And this calculator is going to allow us to kind of really use that side-by-side comparison. So let me go ahead and kind of share with you that screen. By the way, all of tonight's material, we're going to send that back out to you. So all the presentation material that I review with you this evening, we're going to get a chance to send that back out to you. And tonight's class is being recorded. So we'll also send you a link to the YouTube channel so you can get a chance to kind of review this content that we've shared with you this evening. All right. Now, before we continue on, I know our audience is all across the country, so it'd be super helpful if you get a chance, just drop in the chat where you're joining us from. I know most of us are in the Texas market, but I know, the association base is kind of all across the country. So if you get a chance, just drop in the chat where you're joining us from. It's super helpful for me because as I go through market data, we can maybe look at some other areas across the country that might be helpful for you on this journey towards homeownership. All right, so I appreciate that. So let's talk a little bit about the rent versus buying calculator. And we've kind of pre-filled in some of these fields just to kind of help get an understanding of what this kind of looks like. So the first section we're going to look at is the renting section. So we're going to assume this particular buyer has $2,250 in monthly rent. Now, of course, that's going to vary depending on where you're at in the country. We have monthly renter's insurance that factored in at $15 a month. And then we're going to assume that rent's going to go up about 5% on an annualized basis. Okay, so that's the rent side of our ledger. And then from a home purchase perspective, we're going to assume we're buying a house for $450. We have down payment minimum at 3%. That's going to be for a first-time buyer conventional loan, which you're going to learn about loan programs tonight. And then we assume property taxes. Depending on where we're at in the country, those property taxes are going to be at different levels. We have homeowners insurance. We also have the maintenance costs. So we want to budget in, how much is it going to cost me to repair my home if something goes wrong, right? So, no longer can we contact our landlord and say, hey, I lost hot water. That's something that's going to kind of fall on our expense line. And then we have loan information. We're going to factor in a 30-year fixed mortgage. We have the average interest rate, which we're going to talk about interest rates in just a bit. They're a little bit higher than that. Today, average interest rates right around 6.6%. We have origination charges. So that's what a lender will charge me for my financing. So as a preferred lender for you in kind of putting together your financing, we actually discount our services, which you're going to learn a little bit more in tonight's session. But we actually lower our origination charges by $750 to create better affordability for our buyers in their home financing scenarios. And then discount points are where a buyer can essentially pay additional funds out of pocket in order to bring down that interest rate. So when we say discount points, a point is the equivalent of 1% of my total loan amount. And generally that 1% that I pay will help reduce my interest rate about 0.25%. And then there's other settlement services. Those are going to be things like title, escrow fees, maybe attorney's fees, some of the transfer taxes for purchasing my home. So all of those will fall under closing costs. Generally closing costs. So when I'm thinking about saving for home ownership, I'm thinking about saving for my minimum down payment, which in this scenario is 3%, plus my closing costs, which will generally be estimated around 2 to 3% of my total purchase price. And then the last assumption we're going to make is looking at the appreciation of my home, which is at 4%. And then we assume that we're going to be in the house for at least 7 years. That when I sell my house, it's going to be about a 10% expense to sell. Now that varies for different parts of the country, but we're including realtor expenses and closing costs for selling my home. So we're going to make that assumption that I basically sell my home in year 7. We factor in state and federal taxes, as well as a savings rate, which is kind of calculated at 3%. So if we look at our calculator, we first look at the budget side of things. So the monthly budget shows us with a monthly rent of about $2,250. Now, jumping into home ownership, I'm going to rise in monthly outgo, right? So that pushes me to about $3,700 a month. So that's about a $1,500 increase in monthly outgo. However, when I kind of stack together the total cost opportunity of 7 years of owning versus renting, it's going to err more towards the buying side. And the reason why is because when I factor in my home appreciation at 4% annually over the next 7 years, and I factor in my tax benefits, I have about a $68,000 opportunity of owning a home versus renting. So now everybody's scenario is going to be a little bit different. And especially for our buyers that are purchasing in today's market, in the next 2 years, there'll probably be opportunities for us to even lower that rate even further, which creates better buying opportunities. So, everybody's scenario is going to look a little bit different, but in this example, this kind of shows the power of buying. And, as I would say, it's not necessarily an apples to apples comparison when you're looking at buying versus renting. So I would encourage you, as kind of one of your follow-ups from tonight's class, take some time to jump into that calculator, run your own scenario, because I think it'll be super helpful for you. And certainly as we meet with you for a consultation, we'll walk you through that as well. For those of you that dropped in your location in the chat, I appreciate that. That's super helpful because, yeah, as I suspected, we're kind of everywhere. So I have some of us in Idaho, Colorado, Texas, some of us in the DFW area, Georgia. So we are everywhere. So I love that. Okay, cool. So, and by the way, just so you know, as our audience goes, we are a nationwide lender, so we can serve you in any community that you're in. So we just happen to, because we are, it's an A&M based class, we're focusing on Texas, but that's why I always kind of like to ask that question because I'm always interested to know and help wherever we're at in our certain communities. Well, let's talk a little bit about the housing market. So we're going to look at national trends. As I tell most of our classes, like these trends don't look a lot different state to state. They're fairly similar. The median sales price might look a little bit different, but kind of what we're seeing in the market doesn't look super different. The median sales price across the country is $428,000. When we look at what's kind of happening with home prices, some of this is a bit seasonal. You can see kind of some downward movement on prices. This housing market in 2024 has been really interesting. Historically, April and May, we start to see buyer activity pick up quite a bit. It gets a little bit nicer outside. We got warmer weather in different parts of the country. People are starting to come out and about. Homes are going on the market. This year's been a little bit different. We've had a little bit of a delay in buyer activity this year. In fact, we didn't see a lot of buyer activity picking up until probably July or August, most notably because of the interest rate level. I mean, interest rates topped out around 7.5% this year. So we didn't see as much buyer activity, but now it's really started to pick up. I think the average consumer has kind of come to the conclusion that interest rates are kind of what they are right now. And, many people want to get into the market of buying. And so, there is some type of cost to waiting, so to speak. And interest rates will continue to trend down a little bit more, and we'll talk about that in just a few minutes. But that's kind of what we've seen in the housing market. We've seen kind of this lull a little bit. We're now going into the fall and winter months. Historically, we would see a little bit of a slowdown, but based upon what's probably forthcoming with interest rates, obviously we're in election year, we'll probably see activity levels pick up with housing. I think the challenge we have right now is inventory levels. So whether I'm in Texas or Idaho or Colorado or Georgia, there still is inventory challenges out there. There's not a lot of really supply to help support buyer demand. And I think that goes into kind of one of the concerns when we're looking at the housing market is around interest rates, because as interest rates fall, buyer demand picks up. But if there's not enough supply to support buyer demand, we will probably see prices start to increase a little bit more. Now, when we look at interest rates, we're looking at the last 12 months in interest rate snapshots. We kind of look at a kind of a up and down roller coaster ride, so to speak. Interest rates topped out at almost 8% back on October 21st of 2023. Now, since that span of time, we did luckily see interest rates kind of drop down, and we've seen this kind of bumpy road here from an interest rate perspective. And then, rates have started to come down a little bit. We saw interest rates reach a nice low of about 6.1 just about 3 weeks ago. That was as a result of the Federal Reserve cutting rates 0.5%. Now, most recently in the last 2 weeks, we've uncharacteristically now seen interest rates rise a little bit. So we had interest rates average at 6.1. Well, today they're averaging around 6.5 to 6.6, namely because of, what I would say kind of emotions in the markets right now. We're having speakers that are talking a little bit about the economy, and it's kind of now fueling some concern about whether the Federal Reserve will now cut rates another 0.25% in November. So the Federal Reserve has another meeting next month. There was speculation about an 86% chance that they would cut rates about 0.25%. But right now, that has dwindled a bit. And so there's concerns that we might not even see a cut at all. One of the federal chair managers made a comment that the economy was strong and stable yesterday. And so that really sent kind of a lot of shockwaves into the markets and, kind of created more concerns that we might not see a rate cut in November. Now, there is scheduled rate cuts of about 4 rate cuts in 2025 by the Federal Reserve. I think it's important to understand that when the Federal Reserve cuts rates, it's not a one-to-one correlation to mortgage interest rates. When the Federal Reserve cuts rates, you're going to see rates come down on credit cards. You're going to see rates come down on personal loans. Of course, savings rates will come down. So that's the direct correlation. Now, it will spill into mortgage interest rates. In fact, much of the rate cuts that were talked about 3 weeks ago when the Federal Reserve did cut rates 0.5% was already kind of baked into mortgage interest rates. So many consumers were asking the question, well, if the Federal Reserve just cut interest rates, why didn't they go down? Well, a lot of that was already assumed in the markets. But I think as we move forward, I think interest rates will continue to trend down. I don't think it's a question of if, it's more of a when situation. And there's two major events coming out next month, right? So we have the election, which could change the markets. And we also have the Federal Reserve speaking next month as well. So we'll have to kind of see what that looks like for everyone. All right. All right. And I think we have, okay, I just want to make sure I didn't miss any questions in the chat. And of course, if you guys have any questions on kind of the interest rate market, feel free to put those in the chat or question. I think we have someone actually putting some more information into the in the chat here. So we'll have Ken take a look at that for us too. Let's talk a little bit about what goes into interest rates too, because I think that's pretty important when we look at the characteristics of interest rates, because you may talk to one of your colleagues or a neighbor and they may say, hey, I got this particular interest rate. Well, market conditions will drive that interest rate, but it's also factors that go into the characteristics of the loan, like credit eligibility, what my loan program is that I'm electing, how much I'm deciding to finance, what my down payment looks like. Am I paying additional funds out of pocket to bring down my interest rate called discount points? I know we kind of touched on that a little bit earlier. And then the term of my loan can also impact my interest rate. So if I shrink down the term of my loan, that can also potentially lower my interest rate. In today's market, shrinking that term doesn't necessarily help lower the interest rate because we are seeing short-term and long-term rates kind of intersecting each other. Historically, when you take a 30-year mortgage, you squeeze it down to a 15-year mortgage, you would see probably about 0.5% to a 0.75% reduction in rate. But in today's market, we don't really kind of realize those type of changes. So one of the factors that goes into interest rates is credit. And when I think about, educating thousands of buyers across the country, there's usually two concerns for most first-time buyers. One is savings. I may not have enough saved for down payment or closing costs. The other might be on the credit side of things. And so we're going to cover savings in just a little bit, but let's talk a little bit about credit. And I know many of you in today's session have visibility to credit, so you're probably subscribing to some of the different monitoring tools like Credit Karma, for example. Those are all great for you, and it creates wonderful awareness. Most of those models are going to be using a credit card model to kind of keep you up to date of what's going on with your credit scoring. There's actually 3 different models to credit scoring. There's credit card, there's auto financing, and then there's the mortgage model. Now, of course, when you're applying for home financing, we're going to use the mortgage model. So I thought it'd be helpful to kind of share with you what that score calculation looks like for you. And so this is kind of the weighting of the score calculation. 15% is going to be how long have I had credit? So the more mature my credit file is, the higher my score can potentially be. 20% is going to be how much new credit am I trying to gain access to? Am I opening new accounts? Do I have new hard inquiries on my credit? That's 20% of the makeup of the weighting. Now, one of the things we do in our process to alleviate the concern around inquiries, we actually do a soft inquiry just to help develop options for you. So we can actually pre-approve you with a soft inquiry, which doesn't impact your score and allow you to start that home buying search. Where most lenders will do a hard inquiry, and we kind of try to avoid that because most first-time buyers, we're not going to, get pre-approved and then run out and buy a house in 2 weeks, right? It probably takes 2 or 3 months. Some cases it takes 2 or 3 years. So we want to make sure there's no impact to the credit score. So a soft inquiry still gives us visibility, but doesn't necessarily impact the score. And 30%, which is probably the biggest area of opportunity for most home buyers, is around revolving credit utilization, where we're looking at credit balances versus credit limits. And generally speaking, if we are running, let's say, 80% utilization, that means that if we have $10,000 in limits, my balances are probably at $8,000, right? Ideally, we want to be at least below 10% utilization of credit. Now, if I'm at that 80% level and I'm looking for the next level of opportunity, I would encourage that buyer to try to get below 50% utilization, then work towards 30% utilization, and then optimally would be to get to 10% utilization of credit. Okay. Now, the last component is going to be payment history. And we're looking at payment history. We're looking at especially things in the last 12, 24 months that are delinquent events. If you have a delinquency on an account, they're rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. So the more severe I'm at on the delinquency spectrum, the bigger impact I'm going to have to my score. Especially, like I said, in the most recent 12 to 24 months, that's going to be the most impact to your score. Now let's kind of rewind and talk a little bit more about credit utilization, because I want to give you a quick tip on how to manage utilization of credit. So if you were to take a look at your credit card, just pick any one of your credit cards. There's two important dates on your statement. One is the statement or billing cycle date. The other is your due date. The due date, of course, is when your payment is due. And so we want to make sure we pay that on time. But the other date is your statement date. That's when the credit card issuer closes out all the activity, payments, debits like purchases. Those are all calculated into that statement date. If you can get in the habit of paying off or paying down your credit card before the end of the statement date, then you're going to allow yourself to actually get a lower balance reported out to the credit agencies, because on the statement date is the date in which the credit issuer sends out all the information to the credit agencies. So if I can catch that before the end of the statement date, gives me lower utilization of credit, and then in turn get a potentially higher credit score. Now, every loan program has a minimum credit score. So you can see some of those on screen, the FHA loans, conventional loans, some of the government-insured loans like our VA products or our USDA loans, those have minimum credit scores of 620. So every loan program will have a minimum. And then as we tailor different options for clients, we're going to figure out what ultimately is the right fit for you. Now, bigger credit events, bankruptcies, short sales, foreclosures, those will have a bigger impact to your credit score, especially, in the most recent 12 to 24 months, we're probably going to see a bigger shock to the credit score, so to speak. If you decide to close out a credit account, so if you have an old account and maybe you're doing a balance transfer and you decide to close out that old account, I would just be careful in doing that, because what happens when you close out accounts, you do two things. One is you strip away all the history for that account. So if you had that credit card for the last 10 years and you close it out, well, that wipes out all that history from the bureaus for the last 10 years. It also takes away an additional line of credit out of your credit utilization. So if that credit card was $10,000, now I just lost $10,000 in my aggregate limits. So just be cautious before you decide to close out any type of credit accounts. And then in credit scoring from a lending perspective, we are looking at all three agencies' credit scores. So Experian, Equifax, and TransUnion are the three agencies. We look at all three scores, but we do take the middle score of all three. So if my highest score is 760, my lowest score is 740, and let's say my lowest score is 720, well, we're going to use the 740 score from a qualifying perspective. Okay, so that's what I would base my interest rate off, my product selection, even mortgage insurance in home financing. If I have a partner that's going to join me in my financing as well, but let's say my partner has slightly lower credit scores. Let's say there's 700 is my top score, 680 is my mid score, 660 is my lowest score. Well, in that scenario, then we're going to have to go off the lowest credit score between myself and my partner, which would be 680. Now that could change the makeup of what I'm looking at from a product perspective. Certainly it's going to change what my interest rate could look like. Now, as we meet with clients for consultations, we're going to kind of figure out what we can do to help optimize your credit score. So we're going to talk a little bit about maybe past challenges on your credit, maybe where your utilization's at, new accounts that are opened. We want to make sure that we kind of identify any opportunity to potentially get your credit score up, because that slight movement upwards in your credit score can help you save thousands of dollars in your home financing, whether from an interest rate perspective or maybe just the right product or perhaps mortgage insurance. Now, negative items on your credit, this is kind of how long they'll stay with you. This is kind of a matrix to help guide you around that. So if you've had some late payments, generally it's 7 years or less. The impact is the most recent at 12 to 24 months. But in terms of how long it's going to stay on your reporting, it's 7 years. You can see things like public records, bankruptcies, tax liens, those will be on there a little bit longer. This kind of gives you a little bit of a guideline for some of those events. All right, let's talk a little bit about student loans. Student loans obviously come up in my conversations with clients. Now, some of us may have student loan forgiveness, which is great. That means you no longer have those outstanding balances for federal student loan debt. Some of you might be in forbearance. Some of you might have deferment. Now, from a lending perspective, whether I'm in forbearance or deferment, as a lender, we still have to count a minimum payment for qualifying. And there's a kind of a way that we calculate that out. Now, if you're in an income-based repayment option, so let's say you gave your 2023 tax returns to your service provider and they said, you know what, your payments, $250 per month. Well, that's the payment that we can use from a qualifying perspective. But if you don't have an income-based repayment plan in place, then generally for a conventional loan, we use 1% of the total balance. And then for an FHA loan, which is a government insured loan, we would use 0.5% of those balances. So, that can change the qualifying a bit for some clients when we look at student loans. But I think it's important as kind of a takeaway. If you're in forbearance, that there still will be a minimum payment that has to be calculated into the qualifying. So, and I know a lot of us maybe are in that deferment because maybe we're back to school or maybe we're in some type of payment arrangement as a forbearance option. So a question came in the chat, which is, if you're married, does your spouse count, does your spouse count as a partner whose credit score will be accounted for? So we don't count the credit score for a partner or spouse unless they actually apply into the financing. Now, if you're doing a government insured loan and you're in a community property state, then in a community property state, whether that person is on the loan or not, and you're married, then that person's debt gets factored into the equation, not their credit score. But, if you're going to apply in just your name, but you're married and you're doing a conventional loan, then any of your spouses or partners' debts would not be factored into the equation. All right, great question. If you guys need me to kind of detail out a little bit more about student loans, I can certainly kind of do a little bit of a backtrack, but I'd like to just give you a little bit of a basis for how we kind of think through student loans. Now, all of that comes about because all loan programs have various guidelines to qualifying. And so right now we're going to talk a little bit about various loan programs that are available to you. We like to spotlight 5 programs and kind of dive into a little bit of the nuances of some of these programs. Ultimately, when we meet with you to design your home buying plan, we're going to figure out which product matches best to you and some of your goals and objectives for home ownership. But I think it's important to understand a little bit more about what these look like. So the first loan, which you probably heard a lot about is a conventional loan. And a conventional loan falls under Fannie Mae, Freddie Mac. Those loans occupy about 70% of all originations across the country. Now, with a Fannie Mae, Freddie Mac loan, we can go up to as high as 766,550, which is the conforming loan limit. Now, that conforming loan limit is rising up to 800,000. I think it's like 802 for this upcoming year. Many lenders, such as ourselves, have already adopted the new conforming loan limit. So you can go up a little bit higher than 766 level to 802. What's important about that, it allows a first-time buyer to put as little as 3% down to purchase a home. And then for those of you that live in high cost of living areas across the country, so if you're in, New York or you're in California, for some of the Virginia markets, Fannie Mae and Freddie Mac will allow us to go up to as high as $1.149 million in loan amount. However, when we exceed that conforming amount, which in this case right now is 766,550, that minimum payment jumps from 3% down to a 5% down payment. Now, with the conventional loan, the minimum credit score is 620. We're really going to need to see kind of clear credit history in the last 12 to 24 months. So if you've had a few late payments recently, that might be a little bit challenging for conventional loan products. And then with the conventional loan, it generally will give us the lowest price options from a mortgage insurance perspective. And we're going to talk about mortgage insurance in just a bit, because when you put less than 20% down on a conventional loan, you do have what we call is mortgage insurance. Now, the next product is an FHA loan. FHA stands for the Federal Housing Administration. That is a government insured loan. It allows for a down payment of 3.5% up to that conforming limit. Now, FHA loan limits will vary by county. So depending on where you're at in the country, that FHA loan limit will change a little bit. FHA is going to have a lot more flexibility from a guidelines perspective. So if I had, let's say, a late payment on my student loan October of last year, that might be okay with FHA versus maybe a conventional loan might be a little bit more challenging. FHA also has a lower credit score requirement, which is a 580 credit score. We're going to learn about mortgage insurance in just a few minutes, but with FHA, regardless of what I put down, whether it's 20% down or 3.5% down, I will always have mortgage insurance in place. And then for our veterans, there's the VA home loan, which is an amazing product, allows a veteran to put no money down. You can go beyond, I have $1 million on screen, but you can go beyond $1 million with a 0 down payment option. The VA loan has a VA funding fee for the veteran, which basically, depending on your usage of the veteran's product or your amount of, and or your down payment, you'll have a certain amount of what we call VA funding fee that you have to pay. For first-time users that are putting no money down, usually that funding fee is 2.15% of the loan amount. And so that will vary based upon ultimately your loan structure. For any veterans that do have any partial disability from the VA, they're completely exempt from that VA funding fee. The next product is the USDA loan. That is also a government insured loan, but that product's designed to support buyers that want to purchase in more rural areas. There's what we call a guarantee fee with the USDA product. There's two major qualifiers for the USDA loan. You have to be buying in more of a rural area, and you also have to meet income criteria for that particular area. Now, the benefit with the USDA product is there is no down payment, and so that's obviously a huge opportunity. But it does carry with it a guarantee fee, which is usually 1% of the total loan amount. And there's also a monthly guarantee fee, which is at 0.35%. And then finally, the jumbo loan is another product option for buyers. Now, it's not usually the most chosen option. And the reason why is because it's really designed to purchase at the higher limits that exceed Fannie Mae, Freddie Mac limits. Usually with the jumbo loan, you need to have at least a 680 credit score. And there's also some additional asset requirements. So beyond saving up for my down payment, maybe my closing costs, I'm probably going to need some additional assets for what we call as reserves. And reserves are additional funds that I have left behind to show a little bit more financial stability. Those reserves can usually amount to 12 months of my total monthly payment. So if I have a mortgage payment of $8,000 a month, I would need $96,000 in additional assets beyond the down payment as well as the closing costs. Now, I kind of talked a little bit about mortgage insurance already when we're doing our product overview, but I want to kind of dive a little bit deeper into PMI. Before I do that, just want to take one question I saw in the chat that came up, which is there an upper limit on income to qualify for an FHA loan or a 3% down conventional loan? So there is no income limits on FHA or conventional loans. As long as you're a first-time buyer for the conventional product, you're eligible for the 3% down. And then FHA, it's always 3.5% standard, no income limit requirement there. Now, specific to first-time buyer programs, which we'll look at a little bit later, there are income limits based upon what product you're choosing and what state you're purchasing in. All right, so let's talk a little bit about conventional loans on the mortgage insurance side. Now, there's various ways to purchase conventional mortgage insurance. You can pay it monthly, which is the most elected option. There's split mortgage insurance where I pay some of it up front, pay some of it on a monthly basis. There's also single premium where I essentially will basically buy out the mortgage insurance as part of my closing costs. And then finally, there's lender paid mortgage insurance. And essentially what I do with lender paid mortgage insurance is I elect to take a slightly higher interest rate in order to buy out the mortgage insurance. The reason why the number one option is the monthly mortgage insurance is because it has a cancellation option. So once I reach 2 years in my home and I have 22% equity, I can apply to have my mortgage insurance canceled. Now, mortgage insurance isn't the same for all buyers. It varies based upon your credit score, what your down payment looks like, and then how much you decide to finance. Okay, so if some of you, before tonight's class, you got a chance to hop on a Zillow or Redfin, maybe use their calculator feature, what you'll find often is those mortgage insurance examples are significantly higher than the actuals. And the reason why is because they don't factor in some of the key criteria like credit score, down payment, and your total amount financed. So again, there is a cancellation option on conventional PMI, 2 years in my home and 20 to 22% equity. So let's look at an example of PMI in kind of real time. So we have a 450 loan amount, as you can see on screen. We have a 3% down payment and a 740 assumption on the credit score. So PMI is about $183 a month. So quite a bit less than probably what you'll see through some online calculators because we're calibrating everything to those key features. Now, on the FHA side of things, FHA, like I said, is a government insured product. There are two components to mortgage insurance for FHA. There's monthly mortgage insurance, which is at 0.55% of my total loan amount, and then we divide that by 12. There's also upfront mortgage insurance, which is 1.75% of my total loan amount. Now, regardless if I put 3.5% down or 20% down, there always will be mortgage insurance on an FHA loan. The only difference is if I put 20% down or even 10% down, the monthly mortgage insurance drops to 0.50 from 0.55. Now, with FHA mortgage insurance, there are no cancellation options. So the only way to exit mortgage insurance on an FHA loan is if I was to basically refinance out of FHA into, say, a conventional loan product. And what refinancing means is I'm basically taking my existing balance, taking that balance down and moving it to a lower market interest rate. So if I bought my home at 6.5% rate, but now rates are 4.5%, I can now refinance down to that lower rate option. So let's look at the FHA PMI example here. So the same loan amount as our conventional side, so 450. However, we got to add on the upfront mortgage insurance, which is 1.75, or from a dollar's perspective, 78.75. And then monthly, I'm at 206 for just the mortgage insurance. So a little bit more expensive on the FHA side. What you will find if you were to kind of search interest rates right now and cross compare conventional versus FHA rates will show a little bit lower. And here's the reason why is because what's not advertised in some of those searches is the cost structure for the mortgage insurance on FHA. But FHA still has a lot of great benefits because it allows buyers to get access to home ownership, especially if I've had past challenges. Maybe my credit score is a little bit lower, but I still want to purchase. This gives me a great entry point into home ownership because I may have a few late payments in the last few years. Conventional might have some challenges with it, but FHA certainly will give me some more flexibility to enter home ownership. All right, so there's a little bit about PMI. I want to take a quick pause here. I know we got some questions coming in the chat. Let me just make sure that we're good. Okay, I think we're up to date. Any questions from the audience before we kind of talk a little bit about income qualifying and some of the documentation for homeownership? Okay, I think we're good. All right, so let me kind of first share with you some of the documentation that you'll generally need as you're starting this process with us. Usually for W-2 employees, it's the last 2 years of W-2s. So that means I'm working for an employer. Last 30 to 60 days of pay stubs. From an asset perspective, we usually want to see the last 2 months of bank statements. So those are kind of what we'll generally need from a documentation perspective. Now, if I'm self-employed, I do need to see the last 2 years of file taxes as part of the qualifying. Now, one of the things I like to cover in this section is talk a little bit more about sources of income, but specifically kind of time frames, because there is a rule in lending that I have to show at least 2 years of work history and/or education. And here's what I mean by that. If I graduated from A&M, let's say in the fall of 2023, and I just started my job January of 2024, as long as I can show that I had 4 years at A&M and then now I've been on my job for, let's say, the last 10 months, I can show a full 2-year history of employment and/or education. So a lot of kind of misrepresentation out there. Some buyers will think that I have to have 2 years on my job, but it's not necessarily the case. I just have to develop 2 years of work history and/or education. Same thing holds true if I'm switching jobs. So let's say I've been with my employer for 4 years, but then I have a new opportunity and I'm getting ready to start a new job. I can still qualify with that new job. In fact, I can use my offer letter as my earnings to qualify for that home financing. Now, where it gets a little more difficult from the 2-year requirement is if I have multiple jobs. So sometimes we see this in the healthcare industry where maybe I'm working at multiple clinics, it has multiple employers. In that case, I do have to show that I've been working with both employers simultaneously for the last 2 years in order to count both sources of income. That also holds true for self-employed individuals. So if I'm self-employed, I have to show that I've filed taxes under my business name for the last 2 years. And then if I have additional sources of income, so let's say I drive for Uber on the weekends, right? And I really want to show that source of income for qualifying. Well, in that case, if I have my 40-hour workweek job, but I also want to include the Uber income, I have to show that I've been on both jobs for 2 years simultaneously. Okay. All right. Let me just make sure. I know I said a couple questions in the chat. I want to make sure. Okay. Okay. So one question, this is relevant for this section of the class. For someone who's about to graduate from college, how long should we wait to start thinking about buying a home? I think the fact that you're attending class right now is great. I think that means you are starting to think about it. I don't think there's really any time frame to it. I mean, I think ultimately it's kind of figuring out what your income is going to look like, because that's obviously going to build your budget for home buying. But we talk to clients all the time getting ready to graduate and kind of just ready to enter the real world, so to speak, with their first job or whatever the case may be. And so I think it's never too early to plan for that, for sure. Before we leave our kind of our income section of our class, I just want to kind of touch on one thing that comes up quite often, which is around additional sources of income. So if I have a roommate right now and maybe my roommate plans on going with me to my next place or whatever, generally that income is not going to be transferable to qualify for a mortgage. There is some programs that we have that will use rental income. It's not ideal. It can be a little bit difficult to qualify with that stuff. Now, if I have a partner that contributes income to my household, I think this is one of our questions earlier, that partner's income can't get counted into the qualifying unless they're going to be part of the application. Okay, I thought I saw a question. Okay, so King got that one. All right, perfect. All right, so that's a little bit more on income, and I want to kind of stick with that theme of income, and we're going to look at income versus expenses, or what we call as a debt to income ratio analysis, taking a look at what my expenses look like versus what my pre-tax income looks like. When we're analyzing expenses, we're looking at the housing expense. We're not necessarily looking at, maybe our entertainment expense or travel expense. We're taking a look at our housing expense. We're also taking a look at personal loans, credit cards, auto loans, things of that nature that impact that debt to income ratio. So here's kind of what we would see it looking like. So our debt to income ratio is going to take into consideration our principal and interest of my mortgage, the property taxes for my house, my expected homeowner's insurance, and if I pay PMI, then that would also be factored in. So because I put less than 20% down. And then if I'm buying a condominium, maybe a townhouse, I might have homeowners association expenses. So we take that $2,500 a month as housing expense, and then we factor in the credit cards, car loans, things of that nature. And then we take that divided by our pre-tax income. So in this scenario for our client, we're at $3,000 expenses versus $8,500 in income. So my debt to income ratio is 35.29%. Now, guidelines wise for loan programs, we ideally would want that to be below 45%, but some programs will allow to go as high as 50%. That's just a metric for qualifying for home financing. Doesn't dictate necessarily affordability for home buyers. The affordability conversation is going to come during our consultation. Our two big goals for you in homeownership is affordability, but it's also sustainable. We want to make sure over time, if things change economically for you, you can still afford your home. And so the question I get often is about debt to income ratios, like what should it be? And it does vary for everyone, but I do think the comfort zone for most buyers that I work with across the country is about 33 to 36% debt to income ratio. So we're saying up to 36% of my pre-tax income is being consumed by expenses. Now, don't get me wrong, there are some clients also that need to go higher in that. Maybe they have to go to 45 or 48% because maybe just it's the cost of living in their area. Or it's just because maybe they have additional income that they're not able to kind of reflect in their application. But obviously we want to design affordable and sustainable home buying plans for our clients. All right. Let me just make sure. Okay, so Ken's answering. I got one question, the Q&A. So question before we go into assets, and then we're going to kind of walk through the process, and we should be almost at the top of the hour. A question was, how are HOA fees determined? Is there a range of what is fair? HOAs really vary all over the board. And HOAs generally, they're going to be based upon like what are the benefits of the community. So is there a fancy gym? Is there really cool common areas like pools and stuff like that? Could just be the overall expense of the community itself. So I have HOA fees that range from $100 to $1,500. It really just depends on, where you're going to be buying in the country, and then really kind of all, like I said, those characteristics that come in that particular community. But you'll see HOA fees primarily with condominiums and townhouses. On occasion, you'll see smaller HOA fees with single family homes. That certainly does happen, especially in what we call as master plan communities, where maybe you have a community that has, brand new roads and schools and all the different resources. And so sometimes they'll have HOA fees in those communities. All right, let's talk a little bit about assets, and I want to spend some time talking about a savings plan for you tonight. So from an assets perspective, that's part of the equation for home buying. We obviously need to save up for what we call as down payment and closing costs. That tends to be a little bit one of our challenges for clients. So we are going to talk about first-time buyer programs tonight as well, but this is some of the documentation that you generally need in proving assets. So usually the last 60 days of statements. You can even use 401ks, 403bs, retirement accounts at times. I would just encourage you, talk to your tax professional, maybe your financial advisor before kind of accessing those assets. We certainly don't want to create a tax event for yourself. Family can also help support you in your journey towards homeownership. Those are called gift funds. That can certainly be allowed. There is no seasoning requirement to gift funds, but we do have to paper trail where the money has come from. Generally speaking, all assets need a 60-day seasoning requirement, but not with gift funds. So if my mom and dad wanted to help support me with home ownership, they could transfer funds to me right away. There would be no waiting period for that. Now, in looking at saving for home ownership, like I said, it can be a challenge for us. And so I have a real kind of simple approach I wanted to share with our class, and we just call it our savings plan. And it goes like this. So, if I'm in a situation currently today where, let's say I'm paying $1,500 a month in rent, but I truly think that based upon my current level of income, I could probably purchase at a monthly payment of $3,000 a month, right? So right now, I know that my monthly expenses are going to increase by $1,500. So if I'm trying to pursue home ownership, but I'm really lacking savings for down payment and closing costs, what I would encourage our client to do is start paying into your savings account like you're making a mortgage payment today. So on the first of the month, when I'm paying my landlord $1,500, I create the habit of now transferring an additional $1,500, but that goes into my savings account. And by doing that, I do two important things. One is obviously we're growing our savings account. And so at the end of 6 months, maybe I have $9,000 in my savings account. By the end of 12 months, maybe it's $18,000, not including high yield interest accounts that can also help generate more savings for myself. But it also creates a really great discipline for me of getting accustomed to making a $3,000 mortgage payment. So it's not such a payment shock for me when I do buy my home that it doesn't feel like such a big step up to $3,000 a month. So I would encourage you, I know it's a simple kind of approach, but it's just a way to create that discipline of savings because, like I said, it does tend to be a bit of a challenge for some of our buyers. Now, there are programs all across the country that are designed to specifically help first-time buyers, especially those that are in what we would consider low to moderate income ranges. So I know, we have guests tonight joining us from Colorado and Georgia, Texas, all across the country. So each state usually has what we call as a housing agency or HFA. They're named different, agencies across the country, but they're generally called HFAs. Now, there are nationally based support systems like through Freddie Mac. There's the Borrow Smart program, which will basically provide a grant of anywhere between $500 to $1,500 for first-time buyers that can go as kind of a credit against down payment and closing costs. And it ultimately allows the buyer to get decreased home ownership. Within Freddie Mac and Fannie Mae, there also are incentives for low-income housing buyers through what we call the Home Ready product that allows you to get cheaper financing options as well. Specific to Texas, there's the My First Home Texas program, allows you to get up to 5% in assistance for down payment and or closing costs. And then you can set those up as repayment options or a potential forgivable grant at the end of 3 years. But like I said, check with and obviously check with us, and we'll kind of let you know based upon the state that you're in, what programs might be a good fit for you. But there are resources available to you in first-time home ownership. So if you're struggling to make that minimum down payment or just cover closing costs, there are possible resources that we can pull in for that. Let's talk a little bit about the buying process. So, after tonight's class, you may say, you know what, I kind of want to see what a home buying plan might look like for me. And in building a home buying plan for you, we do a 30-minute deep dive consultation with you to kind of really design some goals and objectives for you with home ownership. Now, the output of that meeting that we have with you is going to be to get you pre-approved. And that kind of really starts the ball rolling in home ownership. So we've created kind of this visual guide for you in home ownership. It's called our 6 steps of home buying. So I want to walk you through the milestones of this so you can kind of have a good, clear idea of what it would look like as kind of next steps for you in home ownership. So the first step is pre-approval, and pre-approval basically is a certificate that we provide that shows that you're eligible for your financing. Usually that pre-approval is good for 60 days. It can always be recertified at any time, especially for first-time buyers. It can take a lot longer to find the right home or community that you want to purchase in. So whether you do a consultation now and you purchase in 2 years, or you do a consultation now and purchase in 2 months, that pre-approval just gives you a baseline of ultimately your qualifying. But that'll lead us into step 2, which is the home search. And in the home search, you're going to hopefully partner with a realtor in your local community that's going to show you options that fit your purchase price and really your kind of the things that you're looking for in a community. Now, just about 5-6 weeks ago, there were some major changes in how realtors that represent buyers were paid through their commissions. So it used to be assumed that the seller would pay for buyer commissions in the course of a transaction. However, that has changed now. So buyers do have to have agreements or realtors have to have agreements with buyers and ultimately negotiate their commissions with the selling agent for a home. As you consider home ownership and you partner with a realtor, that's something you're going to want to have in your interview questions just to better understand the commission structure for that particular realtor. But we do have preferred realtors across the country that we can introduce you to, depending on what market you're looking at. Now, as you go through your home search, and some of it's going to start online, and then eventually you'll probably go out and physically look at homes. But we can always update numbers in your pre-approval depending on what homes you're interested in, right? I may get pre-approved for $450,000, but the home I really love is $375,000. We can always make adjustments to those numbers accordingly. Now, if we were to fast forward a little bit, let's say I find a home that I love, and that offer gets accepted, then I move to step 3, and that's called entering escrow. And it has different kind of terminology in different parts of the country, but ultimately I have a ratified agreement with the seller. And that starts kind of the escrow process for the buying. And usually in most parts of the country, that's about 30 days. But, with our streamlined process, we can do it a lot quicker. In fact, we can close as fast as 14 days in certain markets. But ultimately at step 3, the seller's accepted your offer. And so now you know the terms and conditions of your contract. That same day that offer is accepted, you get a call from me congratulating you, saying, hey, guess what? You did it. You have an accepted offer. And then we're going to review with you the next steps in the process and then schedule you for a follow-up video session for you. So that's kind of the follow-up from your initial, because now we start going in and kind of diving in, seeing what do interest rates look like right now. How much are your goals in terms of out of pocket? Let's make sure we're hitting the mark from a monthly payment perspective, all those really important attributes. Now, your responsibility as a buyer at that time is within 2 to 3 days to basically make your what we call an earnest money deposit, which ultimately goes and is held in escrow while you're going through this process of getting your financing in place. Now, that earnest money deposit is usually 1 to 2% of your sales price, and it gets protected because as a buyer in most parts of the country, you have contingencies to your contract that allow you to do your homework or your investigative work on the house. Includes getting the house appraised. We want to make sure the house is worth what you're buying it for. We want to get the house inspected, make sure that there's no issues out there, mold or roof issues or leaking, whatever the case may be, right? And then finally, we want to get your loan approved. And so that's part of our process, is getting your loan approved and making sure everything fits, income, assets, credit, and there shouldn't be any issues at that point in the process. And step 4 is going to be some of the administrative work that we do. And that's getting everything set up through the processing of the loan. We'll probably have your interest rate locked in at that time. There is some strategy to locking in the interest rate at the right time, especially given the volatility of the interest rate market in today's world. But ultimately at step 4, we're getting everything prepped to go to the underwriting phase. And at underwriting, we issue a full loan approval, and that happens at step 5. That also brings us to the end of the contingency period. So if your investigative work turned out good on the property, get your loan approved, your appraisal's good, then you're going to sign off on your contingencies of your contract. And that basically tells the seller that you've done all your homework, you feel really good about the house, and that you're ready to move to the final stages in the buying process. Now, as a lender, we're also going to issue to you at that time a final closing disclosure. It gives you a 3-day cooling off period before we go to the final stage, which is step 6. Along the process, you're going to be getting e-signature updates or e-signature disclosures to be keeping you up to date on what's going on from a disclosure perspective. There's initial disclosures that go out within 72 hours of your accepted offer. And when your interest rate gets locked in, you get another set of disclosures. And then finally at step 5, you get your final closing disclosure. And ultimately, what that closing disclosure does is it basically gives you a clear understanding that there is no changes from this point going forward. So when you get to the very end of the process, everything aligns properly. Now at step 6 is when you actually sign physical loan documents in the process. Now everything up to that point is all done via e-signature, but at step 6, it's all in person. That's also the same day that you're going to wire in final funds for your escrow closing. And at the same time, as a lender, we're going to be procuring the final funds for the closing of your loan. Those monies get receipted in by an escrow company. It's called different things in different parts of the country, but ultimately your money kind of comes into the transaction, gets reconciled, and then documents get recorded with the local county. They record a grant deed, which transfers ownership to you, and then the deed for your loan for the repayment schedule of the loan. And then when that gets all recorded, my favorite part of the day comes. That's when I get a chance to call you and say, congratulations, you're now a new homeowner. And best part of my day by far, I get a chance to, really celebrate with you on that journey that you've just been on. And, like I said earlier, as we launched in today's class, just last week, 2 of your fellow A&M alum purchased their homes. We had both in the DFW area, which is pretty exciting. In fact, they came to classes I think our first class that we had with A&M. So I share that with you because it can happen, and it starts with a class just like this, just getting all the information and the tools that you need to make a good financial decision. And then when that time comes where you feel like you want to take that journey, we're here to help support you. Now, as you're thinking about taking that next step, here's what that looks like for you. So we talked a little bit about a consultation. It's a free service that we provide. That's a one-on-one session with me. So you're going to be spending 30 minutes with me to design your home buying plan. We're going to talk a little bit about credit. We're going to talk a little bit about which programs work best for you, design a comprehensive home buying option. And then if you're in a position where you want to be pre-approved, we'll pre-approve you to start your home buying journey. Now, you may have some questions after tonight's class that may not get answered at the end of our Q&A section. If you want to just get an introductory call set up with us just to learn a little bit more about us or have us learn a little bit more about you, we'd love to be able to hop on a 10 to 15-minute call with you to explore it or answer any questions you might have. So this is the free consultation kind of formatting. We're talking about looking at credit, opportunities around that. That is only a soft credit check that doesn't impact your score. Talk about a little bit about where we want to buy, what's our budget look like, what resources do we need to have around you. Again, it's a comprehensive session that we do for you. And then resource-wise, we do embrace technology. We know there's a human touch or element to this buying process, but we also embrace technology. We do that through mobile as well as notifications via email, but through our mobile platform available through Apple and Android, we'll push notifications out to you in the process of your loan. But more importantly, as you're starting the journey, you can do your application via mobile. You can do calculations via mobile, really kind of have a really great support all via your handheld. Now, we're super proud of our partnership with A&M. It's actually been a really successful partnership very early on in our relationship. I know we have so many more people that we can help in the A&M community. And we do have other partnerships across the country we wanted to kind of share with you. So if you've had friends, family, or coworkers that you think might benefit from our workshop platform, these are open to the public, so they can always enjoy one of our future classes. All of our workshop schedule can be found at mortgageeducate.com. And for our Aggie alum, you actually have your own dedicated website as well, too. So you can kind of check that out as well. Here's all of our links to schedule sessions with us. And then we would encourage you, you're going to have this class up on our YouTube channel tomorrow. You can check out the recorded version. I would encourage you also to follow us on some of our social channels. We try to put out good content for our first-time buyers to help you on this journey towards homeownership. So we'd encourage you to check us out at J Meda Mortgage and some of the information that we're putting out to our local communities. So as we're getting to the end of tonight's class, I do have a few minutes to take on Q&A, and I'll stay here as long as we need to because I think I have some questions popping in now. But I really appreciate the interaction with our class tonight. Hopefully you guys have found this to be an enjoyable and informative session for you. So let's go ahead and start taking some more questions, and then we'll get ourselves wrapped up for tonight. And the first question that I got was, do we offer any teacher loan info? So there isn't really a specific loan for teachers per se. I think there is a company that markets a quote unquote teacher's assistance program, but it's not really an assistance program. Teachers, there are maybe some teacher assistance programs depending on what state you're in that will actually be state sponsored, but there isn't specific to that. Now, we do discount our services for teachers as well too, so we can talk a little bit more about that offline. Hey, any other questions from our audience? I know we're at the top of the hour, so I want to make sure I get anything answered before we wrap up tonight's session. Okay, I think we're good. Okay, well, I really appreciate you guys taking time out of your busy schedules on a Tuesday night. Hopefully, again, you found this information very informative for you. I look forward to hopefully connecting with each of you to help build your own home buying plan in a future consultation. I wish you a great week. Since we're still a little early in the week, have a wonderful week, and I look forward to connecting with all of you soon. Have a good night.